Attendees are in listen-only mode.
Good morning, everyone. It's Ian Smith speaking from United States Connect. Welcome to the latest in our series of Doing Business in the US webinars. This morning we're actually talking about the US tax system and navigating all the different aspects of the tax system. It can be very convoluted and confusing for many people, so we've got a couple of experts from the States to talk to you about that this morning. We could do a 4-hour webinar on US tax, but we're going to try and keep it to our normal time of about 45 minutes. You will have the opportunity to ask questions, and please use the technology to do that. You can type your questions into the system, and we'll be answering those questions at the end. If we don't get to answer any of the questions, we'll actually take them on notice and send them out to you. So please send those questions through. And obviously our two speakers today will be available afterwards. I'd just like to pay special thank you to the Export Council of Australia, who helps us host these webinars. They do a fantastic job in terms of supporting and also representing the interests of Australian exporters. And I know the federal budget's coming out today in Australia, and the Export Council's been very active in trying to get some good outcomes for Australian exporters. So thanks very much to them. So without further ado, I'd like to introduce our first speaker, who will be known to many of you, Patrick Fazone. He's a partner at Montgomery, Fazone and Taylor and has offices in Washington, DC and Sydney. He serves as outside legal advisor to a large number of Australian companies already. And most of those companies are seeking to establish and grow their business activities in the States. He advises and assists clients on all aspects of doing business in the States, and one of those core competencies of Patrick's is US taxation. So as I said, without further ado, I'd like to pass over to Patrick, and we'll get his presentation started. And we will come back to questions at the end of the session, so please type them in as you go along. Over to you, Patrick.
Thank you, Ian, and I'll wait to see the first slide if you can move to that, or perhaps the second slide. What I wanted to do is to talk today about a couple of core concepts. First, I thought I would start with a brief introduction about the U.S. system of tax laws, then move on and discuss the U.S.-Australia Tax Treaty, which modifies U.S. tax law and Australian tax law, and mention state taxation laws in this section. And then finally, a few words about the importance of tax planning, and then turn it over to talk about a few topics. So as you see from the first slide, the U.S. has a system of tax laws that consists of potentially up to 3 levels of taxation. And these include not only sales and use taxes, which Steve will talk about, also Revenue Service, ARS. As in Australia, we have in the United States a general corporate income tax at the federal level, corporate income progressive tax with a top rate of 35%. But in addition to the federal government, we also have state tax authority as well, including state income tax authority. The income tax rates for the states vary. Some have no corporate income tax, and the highest rate goes up to, I think, 12%. So effectively in the United States, you can have an overall tax rate of almost 40% at the corporate tax level. These tax laws at the federal level, at least, have been modified in a series of tax treaties between the United States and various trade and investment partners, including Australia. We have the next slide, Ian. In any case, speaking of the treaty, the United States-Australia Tax Treaty was first entered into in the early 1980s and modified in 2001, and it includes various provisions primarily addressed to taxation of income, including things like business profits, dividends, interest payments, interest income, and so forth. So the tax treaty, and the purpose of the tax treaty, is to avoid double taxation where practicable, but it only applies in the United States at the federal level unless state tax rules have adopted provisions of the treaty. And so whatever rules apply in the treaty apply primarily to the federal tax laws. Next slide, Ian. When dealing with the, I think really the cornerstone of the treaty is the way that it handles, at least for present purposes today, the way it handles business profits. And so under the U.S. tax treaty, it modifies the tax law in the Internal Revenue Code and introduces this concept of the permanent establishment. So effectively, under the treaty, revenue can be subject to federal income tax in the United States if it is earned in connection with a permanent establishment in the United States. And that's a key concept at federal tax level. Article 5 of the treaty provides some very specific guidelines on what constitutes a permanent establishment in the United States. One form of permanent establishment is a fixed place of business, and there are specific types of places of business that would qualify as a permanent establishment. And that includes things like a place of management, a branch of a company, an office of a company, a factory, and so forth. There are various other standards as well, or examples as well. Next slide. Also, Article 5 is very specific on what is not a permanent establishment, and that includes things like use of facilities for storing goods in the United States, or the maintenance of a stock of goods belonging to an enterprise. So under the treaty, if an Australian company maintains a stock of goods in a warehouse run, let's say, for example, by a fulfillment house, that should not constitute a permanent establishment if there are no other activities conducted in the United States. Importantly, there are a couple of other instances in which an enterprise can be deemed to have a permanent establishment and then be subject to U.S. federal corporate tax. One is if it carries on business through a person that has authority to conclude contracts on its behalf and exercises that authority. If you go to the next slide, there's another couple of examples. One other example is if an enterprise maintains stock for rental purposes for more than a specified period of time. If we could have the next slide. So if an enterprise maintains substantial equipment for rental or other purposes within the U.S. for a period of more than 12 months, that could be deemed a permanent establishment. So just a few points there with respect to the permanent establishment standard. If an Australian company were to maintain an office and a warehouse in the state, let's say of New Jersey, and it accepted orders and shipped to users from that facility, its net income from those sales might be subject to U.S. federal income tax. One good thing is that the treaty does exempt from federal tax sales that are made directly from the Australian company, even if it maintained a permanent establishment in the United States. So that is a break and an improvement over U.S. law generally, but it does obviously raise an important issue that if an Australian company wants to do business in the U.S. and wants to maintain goods there, it would probably want to be very careful in how it structures that business activity to try to avoid federal corporate income tax if possible. Ian, could we have the next? Earlier. Next slide, please, Ian. And the issue that that you want to be aware of is that although the federal laws are modified by the treaty, the state laws, income tax laws, may not be affected at all by the treaty.
Patrick, we seem to be having a bit of a problem with your connection. We might just come back to the state nexus rules if we might just move on to Steve. And if you can just try and fix up your connection and we'll come back to you. So I'd just like to introduce Steve Winterstein. So he's coming all the way from Chicago. And Steve will be talking about state sales and use taxes in the states, and also giving us some tips on some strategies in terms of saving on tax in the states. Steve specialises in sophisticated tax and business planning for individuals and small to mid-sized companies. Steve has done tax planning for many companies involving mergers and acquisitions, divestitures, restructures, real estate and like-kind exchanges, and he's Frost Ruttenberg's go-to person for international income tax planning. He joined Frost Ruttenberg in 2008 and has over 30 years of public accounting experience, including 9 years with a national CPA firm and more than 10 years working as tax director with one of the wealthiest family groups in Illinois. So without further ado, I'll hand over to Steve, and we'll try and get Patrick back on the line. The joys of technology. Either way, you will have access to the presentation afterwards, and we'll take questions for Patrick at the end as well, but we'll try and get him back on the line. Thanks, Steve.
Thanks, Ian. I appreciate it very much, and I appreciate Patrick's comments as well. As you'll see, they are important to the discussion I'm about to have. The first segment I want to talk about is the basics of state sales tax here in the United States and when they're likely to apply to inbound businesses. And then I'll recap by comparing the sales taxes to value-added tax. On the next slide then, you'll notice that there is no federal sales tax in the United States. There is sales tax imposed by 45 states here. They all have their different rules, and there are municipalities that have state taxes as well. So it can get to be several thousand of taxable entities, but certainly for the 45 states if you have Nexus, and we'll talk about that in a few minutes. The filing of the sales tax returns is often monthly, sometimes it's quarterly and annual if your sales volume is a little bit lower. And it's a large part of states' funding, and so you'll tend to find that they're willing to spend a lot of effort to gain compliance. And lastly, the last point there is that the rules are changing pretty rapidly on Nexus, and the states are rather poor, and they're working hard to expand the definition of sales tax and to pull more companies into the sales tax realm. On the next slide, we'll get to the basics that's very important. The sales tax is a gross tax, a flat rate on the gross sales price of tangible personal property to the end user. And so if you, for example, had $1 million of sales in Illinois and they were at retail, and you find us, let's say, the state rate at 7.5%, you'd be required to charge those customers $75,000 and remit those monies to Illinois essentially as agent for the state. If you don't, Illinois does have the ability to come after you, and you might find yourself in a position of chasing down your customers for those monies that you didn't charge, and it's very difficult. The use tax is the complement of the sales tax. Again, it's on the use of tangible property when no sales tax has been charged. So if my brother, the dentist in Illinois, orders dental supplies from New York and they don't charge him any sales tax because they have no connection with Illinois, my brother is required to self-assess and pay use tax because he is the ultimate consumer of that product. Next slide, please. Each state's got its own rules. The tax is applied at retail. So if you're selling as to a wholesaler or retailer, essentially selling at resale, the sale should be exempt for sales tax purposes. There is certain documentation that should be in place in order to obtain that exemption. Notice that I say that it is a tax on tangible personal property, inventory and the like. It does not include real estate. Real estate has its own transfer taxes in the U.S., as you can imagine. And most states have stretched the definition of tangible personal property to include software sales. Most states have a limited number of services that they charge sales tax on. You'll find that's more a nature of value-added tax. Only a few services and only those that are listed. And you'll see on this slide, they also have some excluded and exempted sales depending on the agenda in the state. Some states will have a lower rate or no sales tax on medicine, water, or certain food products. Sales to charities and governmental agencies are typically exempt from sales tax. And sales to manufacturers, manufacturing equipment is often given a special break because each state is trying to push manufacturing within its state boundaries. On the next slide, please. So the question is, when are you required to charge sales tax to your customers in the state? And there has to be nexus, and nexus is defined here, some connection between you and the state before they can impose it. Now, we have a famous court case here called Quill, where the courts reaffirmed that you have to have physical presence in the state before a sales tax can apply, but as we'll see in the next later discussion, that's been expanded quite a bit. Physical presence often means a property in the state, a payroll, and so as Patrick may note, if you have a warehouse in the state, I think he'll note that there may be some states that still would require you to perhaps file state returns even if you're not required to file with the U.S. So you generally had to have a physical presence in the state in order to have the requirement, some employee, an office, something, independent reps soliciting sales for you before sales tax would be required. As you can see on the next slide then, we've got a lot of changes in this physical presence rule. One thing is called click-through nexus. Essentially, nexus can be created. You can have a connection with the state if one of your affiliates is operating in that state, for example. And so what they've done, the states have come up with a clever thing, and they said, well, what if another company's website promotes yours? You get some sales in that other state because of that, and you give those people a cut. Then essentially what click-through nexus says is you have an affiliate then through that website, and you are required to charge sales tax to that remote state. Then there's the Marketplace Fairness Act. Now this is a U.S. legislation that has not gone through, proposed legislation, and I wanted to bring it up because I want to compare it to another definition later. But essentially it's legislation that would enable states to collect sales and use tax from remote retailers with no physical presence in the customer's state. What's happening in the United States is that, and I'm sure all around the world, is that the brick and mortar company has somebody walk in and buy something from them. They must charge sales tax for that product, and yet that same customer could then go online, perhaps order something quite similar, and the company that they're ordering from has no connection with the state they're living in, and they don't charge sales tax. Now the user is supposed to pay the sales tax in the form of a use tax when they get the product, but that's often not done. And so in order to try and have a level playing field, Congress is considering, or at least trying to, ram through a legislation that would require online or out-of-state retailers to collect tax on sales at retail to customers all over the United States. Again, that's not law yet. Down at the bottom, there's economic nexus. This is really a state income tax rule, but as Patrick notes in his slides, there tends to be a blending now of the arguments between nexus for state income tax and state sales tax, which are two different things. and two different criteria, but they're beginning to blend and blur over time. And the economic nexus essentially says, if you sell enough into our state, then you are projecting and sending enough economic activity into our state and benefiting from our state infrastructure that you should be required to pay income taxes in that state. And I look at the Marketplace Fairness Act and the economic nexus rule, and I see how close they are in their arguments that someday they'll be requiring online retailers to file in many different states. The contrast then between sales tax and value-added tax. Sales tax is imposed on the ultimate consumer. There's many exceptions and exclusions. It's not recoverable. Once it's turned over to the state for the sale, that's fine. And there's no U.S. sales tax. Value-added tax is imposed through the asset supply chain, imposed on many transactions. The input VAT's recoverable against the output VAT, and it's imposed by nations as well as provinces and territories. The next slide. As Patrick mentioned, you may have state taxes even if you don't have a permanent establishment for the U.S. Sales tax is a percentage of gross sales price, and so it can get to be a pretty large number if you have failed to collect it and remit it to the state, even if your company is currently not operating at a profit in the United States. So it's something you have to take into account very carefully. And hopefully if you have questions, you'll give those to me later. I'm ready to move on to the next segment. Part of the reason I want to go over this is I want to clear up some confusion, and I also want to cover the basics for setting up here in the United States, because you have to master these before you can move on to more sophisticated planning. We'll cover structuring the U.S. entity, business models, a quick word on financing, and one more word about a special state tax. On the next slide then, you've got an awful lot of leeway in where you locate your business, although oftentimes that's dictated by the needs of the customer. You also have a lot of choice to what business entities you set up. And so we could go on for quite a bit of time, but let's talk about the three main choices. One would be to set up a limited liability company here in the U.S. owned by one investor, a limited liability company owned by more than one investor as a partnership, and the more common one, a corporation or LLC electing to be treated as a corporation. Next slide, please. If you set up a limited liability company in the United States to operate here, it probably will provide some limited liability protection. The limited liability company itself, though, is disregarded for U.S. purposes, and therefore the investor, the owner of the LLC, is the one that would be considered the U.S. taxpayer for filing purposes. And so if you have a private company that's a sole owner, you will be filing here in the United States a corporate income tax return, a Form 1120-F, and you'll be considered a branch that's taxable here, as Patrick pointed out earlier. Next slide, please. If there's more than one owner to an LLC, again, you might have some limited liability protection doing it that way. The LLC will be considered a partnership. It files a return here. It's an informational return. There's no U.S. tax. There may be some small state taxes on partnerships. So it would report all the activity here in the United States, and then it would attach to that a breakout of the income by partner. And as you can see from my last bullet point, those partners would then be required to file in the United States to report that activity and pay tax based on their structure. So if it's corporations that own the LLC, they would be required to pay a corporate income tax on their separate holding. The most common, of course, is a U.S. corporation or limited liability company electing to be treated as a corporation. Provides some limited liability protection again. The U.S. Corp is, let's say, a subsidiary of the investor, and the U.S. Corp is the tax-paying entity at the progressive rates leading up to 35%, and of course there would be state taxes as well. Many investors would choose this entity type. I want to mention representative office briefly. You can do preliminary research here in the United States, some advertising and promotion, coming to the United States to scope out how your product might do distributions and that type of thing. You can't really have that much authority to prove sales or transact business, but you can operate for a short period of time in the United States without incorporating and likely not a permanent establishment for U.S. purposes. There's some risk of state taxation, although again, if the period of time that you're doing your research is limited, I don't see that as much of an issue. Next slide, please. U.S. branch. Well, if you hold an LLC all by itself without making an election to be treated as a corp, of course, you will be filing here as a branch. You can come right here to the United States and start operating business. We have a number of companies that have a Australian private company that comes here in the United States and starts operating. It would be required to file a corporate return here in the United States. There's also a concern, something called a branch profits tax, when you have a deemed repatriation of assets back to the home office. Sometimes makes the timing of taxation of repatriation of U.S. profits a little more difficult. It wouldn't be my first choice for entity structure, but certainly if you have losses at first that you think could flow back to your home office and offset trading profits, it certainly has its advantages. And on the next slide, we'll talk about the U.S. subsidiary. Again, provides a limited liability protection. A little easier to time the repatriation of profits and do your foreign tax credit planning. You will be subject to U.S. withholding taxes on the repatriation, but you tend to find that will be zero or a low rate with the treaty between the U.S. and Australia and New Zealand. You're going to be taxed 35%, and of course there's the state income tax rates as well. The last couple of bullet points are essentially saying, and this is something we bring up all the time, you can incorporate here and set up a little marketing arm, and the marketing arm, without the ability to approve orders and like, with some limited authority, can act as a marketing arm for you and earn commissions. Now the sales, of course, would be between Australia or New Zealand and the United States, and they would record it. You would record it there in your home country as the sale. But the marketing arm can help with certain limited marketing activities and pay hopefully a reasonable level of tax on their commissions. Then, of course, the last point is the U.S. subsidiary can act as a full trading company with full range of authority. Next slide, please. One quick word about financing your investment in the United States. Certainly you can use debt or equity. Just be aware of the fact that the U.S. does have some rules in place to prevent foreign investors from offsetting too much of U.S. income with interest expense, essentially interest stripping. So for example, if you were to invest $20 million in the United States effort and said 1,000 was stock and 19,999,000 was debt, the interest on that number might preclude profits for some period of time. The U.S. has some rules in place that might cause some of that interest to be deferred until a later date. Next slide, please. I won't repeat too much of what Patrick's already covered. You could end up with some state taxes, even if you don't have U.S. tax. There are some states here that have no corporate income tax at all. On occasion, we'll find that someone will set up in Nevada, for example, and direct sales activity toward California, which is a high-rate state and for which there are a lot of business to be had. Just be aware of the fact that there are some states that have no corporate income tax at all. Next slide, please. One other tax I want to apprise you of. We have taxes on real estate here in the United States. Helps fund a lot of local business, schools, fire departments, and that type of thing. But a number of states also have a business personal property tax, and that is a tax on business property other than real estate that's held on a particular date, and that can include inventory. So that can come as a bit of a surprise to foreigners when they come here to the United States the first time. Now, there's some states like Texas that very much want you to store your inventory in their state, and so they will often provide exemptions from their personal property tax if the inventory is not held for a significant period of time and then it's shipped out of state. But be aware that there's still quite a few states, Wisconsin, Indiana, that do have these. When you're setting up the entity type, this will have some strong bearing on your taxes. I know that you can't always choose where you're going to locate, but see a tax advisor. There may be some advantages that can be had, and plan for the repatriation of your profits early on in the process. Ian, thank you very much.
Thanks, Steve. I'm not sure whether we've got Patrick back on the line. Have we, Patrick?
I think I'm back on the line. I hope so.
Fantastic. Well, we lost you there for a while. Are there any other comments you'd like to make in respect to what hasn't been covered by Steve?
I think the coverage so far has been good and comprehensive. I just wanted to offer two insights or comments on working with a lot of Australian companies. One is there's oftentimes a lack of appreciation of the fact that taxes might be applying, whether they be sales, use tax, or state corporate income taxes. And so folks will get started in a particular type of business and only later on become aware that maybe they should have been collecting sales tax and remitting it. And so definitely it's really critical to get this type of information before you engage in the activity rather than later on down the line for obvious reasons. The other one is just I wanted to mention a misconception. Again, it's been my experience. A lot of Australians come back from the U.S. and say, oh, well, I understand I really need to be setting up a limited liability company. And as Steve pointed out, there are issues with setting up any type of entity in the United States. Typically, Americans prefer LLCs, small to mid-sized companies, because can be very favorable tax treatment for them. But that doesn't mean that one size fits all. And for the overseas investor who wants to set up an entity in the United States, setting up an LLC may not be an ideal approach, unless, of course, you elect to have it treated as a corporation. So just those two comments, Ian. I think one of the reasons why this is such a great webinar to have is hopefully to apprise people that they want to do some of this research in advance.
Fantastic, Patrick, and thanks for that. And just to let people know, we will be circulating the presentation after the webinar, so you will be able to review the remainder of Patrick's slides. And that's the beauty of doing these webinars and having these experts from overseas, is that sometimes we have those technology glitches, but it's great to have you back on, Patrick, and just in time to answer some of the guys' questions. So just kicking that off, and we had this question yesterday, Patrick, and I just wanted you to cover it for the rest of the audience. The W8BEN form from the IRS. Yes. As it particularly relates to service companies. So if I'm an Australian company that provides services to a number of US clients, the question was, do I need to fill that form out? And what does that mean for me back in Australia?
Yeah, thanks, Ian. I did see that we had received that question before. Really, you don't always see folks receiving a W8BEN, now it's called W8BENE form, but in actual fact, the prudent U.S. company would almost certainly issue one because it essentially gives it the documentation it needs not to withhold any sort of withholding from the payment that it makes to the Australian service provider or other vendor. So there are no consequences for the Australian company in completing and submitting a form, but what it does is establish the basis for a lack of withholding. The typical situation that you see is where some fee for service is being provided, and before payment is made by the U.S. company, they ask for a W8BEN form to be completed. asserting a lack of permanent establishment and therefore a lack of any sort of tax liability or need for withholding. But the onus is on the U.S. payor in this instance because they're deemed under the law to be the withholding agent. So they're acting as an agent for the U.S. government. So they are liable if they get it wrong and don't withhold when they're supposed to.
So just following on from that, and I might throw this one to you, Steve. Nathan has asked if he's selling through Amazon, so he's selling directly to Amazon in the States and fulfilling through their warehouses. He's filled out a W8BEN, but how's the tax treated in that respect? Are federal, state sales taxes, are they held in the States or are they applied in the States? And what does that mean for the revenue that's passed back to his company in Australia?
Well, my general understanding is that if you're selling through Amazon, in those states for which they have warehouses, you may have the responsibility for charging sales tax and remitting that to the different states. I don't know what Patrick's feeling is on this, but from what I've seen so far in the law, there's a real possibility that if you work with Amazon, they may help you quite a bit. They may provide quite a bit of help in that regard. But I think that where they have, setting aside click-through Nexus for a minute, where they have warehouses, my understanding there's a possibility that you would be required to charge sales tax.
That would be my understanding as well, Stephen. As a matter of fact, the tax treaty really does not deal with sales and use tax. And so even if you're not taxed on any income that the Australian company has earned in the United States, the state still may well have liability for sales and use tax. And my understanding was in-state sales could well trigger that requirement.
Exactly, and we're told as a precaution when you're dealing with Amazon to get an idea where their warehouses are located, but that's another issue.
And Steve, I think you've already answered this question, but the follow-up question was if you're using Amazon's warehouses and selling through them, does that create Nexus? And I think you said that having a warehouse doesn't necessarily create Nexus. Is that right?
Well, it may not for U.S. purposes, and you might, as I think Patrick's slides talk a little bit about warehouses in Illinois and in other states, they may very well say that you do have Nexus in the state, and so the question then becomes not whether there's sales tax Nexus. I think there is. The question is whether or not you even have income tax nexus from a state income tax standpoint. You may not for U.S., but you might for the state, yes.
Yeah, and it gets right back to that whole question of how the states regard income tax and sales tax. And so even if by rule of thumb you think you're safe under the treaty and there's no U.S. federal state income tax or state federal income sales tax, nevertheless, you may still have some state tax liability, whether it be income or sales tax. And of course, for income tax purposes, the nexus rules are based primarily on those economic nexus points that Steve mentioned.
Thanks, Patrick. There is another follow-up question. I'll put all three of them in an email to both of you, and we'll follow up with you, Nathan. We'll take that offline. It is fairly specific to your business. We've actually got a question from Kirsty. So she says, I was wondering how to determine in the preparation of income tax returns how you determine what states you should be lodging income tax returns in. So she has a software as a service company and they operate cloud-based software and often sell to other companies that bundle their services into their products. We therefore don't often know where the end user of the service is. I would assume in that case, if they're selling that software as a service from Australia, it may fall into what we were talking about before, Patrick.
Yeah.
So what?
Yeah, I think so.
Yeah, what's the advice in terms of? I mean, there's many Australian and New Zealand companies now that are selling software as a service into the States. Have you got any advice for them?
Are they licensing or are they selling are they licensing the software?
I believe they're licensing. Kirsty, you might just want to clarify that, but I believe they're licensing.
There are an awful lot of states. Patrick would probably be better to answer this, but forgive me for interfering. But there are an awful lot of states that will require sales tax on rental and rental of equipment. And Texas recently came out with a ruling that said they treat software that's being leased or licensed in the state of Texas as possibly subject to sales tax. The theory being that you have presence there because you have tangible personal property there, even though sales software may not ever be considered as truly as anything but an intangible. So I think there are some states that will charge sales tax on the licensing of software.
Okay, well,
Yeah,
is that your understanding, Patrick?
yeah, I think it's possible. It's quite possible. I mean, every state is different, has different exemptions from the sales tax. The other thing I was going to mention too is depending on how that software is delivered, you always have the question of whether or not the company that actually has the software, if it's a service, whether they're actually they have an economic nexus by dint of their presence in particular states. So I gather from Kirsty's question that there may only be arm's length licensing of the software, and then their U.S. Licensee is a reseller. In which case, I don't know. It's not clear to me that they would have any nexus at all. But if her company is actually providing some sort of service on the ground where they are present in various states, then there could be a requirement of registering to do business, and then also potentially having to file an income tax return.
Okay, well, we'll take it offline. We'll get some more information off Kirsty. It is licensing, she's confirmed, but we'll get some more information and we'll get that question answered. We'll also circulate the answer to all these questions to everybody that's participated today. So SG has actually asked, are there any resources that show the current state sales tax rates around the country? Is there one resource where you can go to find all those?
Yes. Yeah, you can find that information online. There's a compendium of states and their rates.
Okay, fantastic, Patrick. So again, we'll circulate that to SG and everyone that's participated today afterwards. We had a question that looks a bit more import related. So they've got a US-based business in LA that's selling goods back to Australia at retail. The question is, what would be subject to? Would that be subject to sales tax if they were making those sales back in Australia to their retail establishment?
Steve, I don't know what your view is. That doesn't sound like that would be based on, there would be any basis for sales tax because that's an international sale, isn't it?
Exactly right, exactly right. And so if I have an operation here, Australians, let's say, have an operation here in Illinois, and they ship product from Illinois to Iowa or Indiana or Australia. Because it is outside their state of nexus, it's quite possible that they have no sales tax filing responsibilities at all. So certainly if I ship from Illinois to Indiana and I have no connection with Indiana and I'm not required to charge sales tax, I certainly think that if I ship from Illinois or LA to out of the country, that there'd be no sales tax responsibility at all.
Okay.
Yeah, that would be, that's my experience.
Thanks, Steve. Thanks, Patrick. Look, I think we've come to the end of the questions today. There are a couple of others that are quite in-depth, so we'll take them offline and we'll send them through to you and circulate the responses. Just briefly, a quick plug for United States Connect. So US Connect was set up in September last year. There's about 50,000 words of content on the site on every aspect of doing business, including US taxation. but more importantly, the site actually links you to rated service providers. So all of the service providers are rated on their service by other exporters, and then you can go in and see those ratings and make sure that you're dealing with someone you can trust. The good news for everyone is that it's free to join, and you get access to that 50,000 words of content plus the rated service providers. Just a quick plug as well from the Export Council. So it's that time of year again. The New South Wales Export Awards and a lot of the national export awards are coming up. So we encourage everybody to apply. It's a great way to get recognition for your company if you're doing good things in export. You'll be rewarded for your hard work, and also it allows you to benchmark against other companies in your industry and across other industries, and also network with them throughout the process. And I know that some of the larger companies in Australia have really benefited from applying for the export awards. So I would encourage you to do so. If you need more information, there's a contact there, Kristen Mulligan from the Export Council. Give her a call and make sure you get your application in. So in closing, I'd just like to thank Steve and Patrick for their time this morning. Apologies for the glitch in the technology, but we will circulate the presentation. If you do have any other questions, please send them through via email and we'll get them answered as quickly as possible. And if you've got any feedback on other topics that you'd like to cover in our monthly webinars, please send them through. This is the 5th in a series, so if you've missed the other 4, again, please contact us and we can send you the links. I hope everybody has a great day, and thanks very much, Patrick and Steve.
Thank you, Ian.